Well, thanks guys for having me here. Thanks, Evan, and Professor Grunfest, who's not here. I'm sure he's having more fun than the rest of us, but this is good fun for me. Before I begin, if you guys have ever heard anybody from the SEC speak, you've heard them give the common disclaimer, which I have to give, that my comments are my own and don't necessarily reflect those of the commission or other commissioners. So that said, now I can really tell you the truth. You won't hold me to it, although I'm being recorded, so I'm a little nervous here. So I thought we were trying to come up with titles of things to talk about here, and we figured 4 years after the crisis is a pretty relevant topic because, as happens so many times in Washington, what we're doing at the SEC right now is, as some folks would say, fighting the last war. We're still regulating to address the financial crisis of 2008. 2009, some would say, the continuing financial crisis, but largely the events of 2008. And for those of you who have no familiarity with the SEC, I'll just give you a real basic background. The agency obviously is an independent agency, was created during the New Deal in response to another crisis, the stock market crash in 1929. There are 5 commissioners. I'm one of 5. Despite the fact that I was appointed by Barack Obama, I'm actually one of the Republican commissioners. By statute, in the 34 Act, there have to be a constant minority. So there are only 3 commissioners can be of the same political party as the president. And so I think that was kind of one of the balances they tried to put in place in the New Deal legislation, creating these independent agencies, which, quite frankly, as you know, are neither fish nor fowl. We're not part of any of the 3 branches of government officially. Folks more closely align us with the executive branch. These days, of course, as we implement the Dodd-Frank financial crisis legislation and other pieces of legislation, we feel like we're a subsidiary of Congress, issuing rules to implement statutory mandates. And so the SEC role in the crisis, I think there are many narratives out there about exactly what the SEC did or did not do during the crisis. Some things are clear, that many of the regulated entities that were registered with the SEC experienced extreme stress during the financial crisis, most notably Bear Stearns and Lehman in 2008. I actually, as a staff member at the SEC, became deputy director of the Division of Trading and Markets in the summer of 2008, about 6 weeks before Lehman went under. So I actually owned for 6 weeks the program that was called the CSE program, the Consolidated Supervised Entity program, which was a holding company oversight program for the biggest investment banks. It's a really a tragic tale in some ways that the CSE program is now defunct because we lost, obviously, all of its members. We lost Bear Stearns, we lost Lehman, and then with the conversions to bank holding companies of Goldman Sachs and Morgan Stanley, the sale of Merrill Lynch, we lost the rest of our registrants. So we were no longer, and we are not now, a holding company supervisor. And if you read a lot of the stories, Too Big to Fail and other extreme works of fiction about the crisis, you'll be led to believe that the SEC was just a bunch of morons and very deregulatory, weren't paying attention. I'm the first to say, obviously, no regulator in the crisis has clean hands. But the problem with things like the financial crisis is the story is usually written by the victors. And in this case, to me, the victors are the bank regulators. And because victory could only be had in this crisis if you had access to the Treasury, to taxpayer dollars. And at the SEC, we don't have access to taxpayer dollars. We, besides those that we are appropriated, we're an appropriated agency. We're overseen by our appropriations committees and our oversight committees in Congress. I think this year, this fiscal year, we have about a $1.3 billion budget, and that's all we get. And there have been efforts made to have the SEC self-fund itself. We charge transaction fees on securities transactions. We could actually probably be a $2 billion agency if we were allowed to take those in, but we actually remit them all to the Treasury, and then Congress decides with the president what we're going to get each year. So as an overseer of the capital markets, that puts us at either a distinct advantage or a distinct disadvantage, as we learned with Bear Stearns and Lehman. Because if you can't provide facilities, if you can't provide bailout funds and the like, your entities simply fail. And quite frankly, that's the construct with which we regulate. Failure is actually built into the SEC model. Products fail and the entities fail. Our job is to make sure that if the rules are followed in a situation like Lehman Brothers, if Lehman fails, the customer assets are still there and they're given back to the customers, and that there's enough capital, and broker-dealer regulatory capital is very different than bank capital. There's enough capital there to unwind the firm in an orderly fashion. It's very different than a bank model, safety and soundness model, where you're worried about the ongoing viability of the institution. You're worried about the ongoing viability of the system, and you have capital for very different reasons. And so, in the SEC model, what happened with Lehman is exactly what we expected to happen to one of our firms if they hit that sort of trauma. And as unfortunate as it was, quite frankly, and as much as it's pushed the bounds of bankruptcy law, it's actually worked as one would have predicted, but of course no one would have predicted a Lehman failure. So the CSE program has been oft vilified and blamed for being a cause of the financial crisis. And interestingly, though, Professor Lowe at MIT and some writers, Bethany McLean from Vanity Fair and others, have written more recent articles actually defending the CSE program and saying, look, if we're going to regulate, if we're going to respond appropriately to the financial crisis, we need to really pay attention to what the root causes of the crisis were. And in blaming the CSE program, we're not doing that. And we need to kind of move on to the more core issues. The CSE program, one last word on it, was created in response to a mandate in Europe that basically said, they put out a directive called the supervision of conglomerates. And so basically said, if you're active in Europe and you're an investment bank and you don't have a holding company supervisor, which none of the big investment banks had, then we're going to regulate you at the holding company level. And nothing is quite as scary to a Wall Street bank as the notion of the French overseeing you at the holding company level. And so and maybe the second best would be the Fed. And so they prevailed upon the commission at the time, which was about 2004, to create a program for holding company oversight. And that resulted in the CSE program, Consolidated Supervised Entities. The problem, again, with that program at the end of the day was, unlike the Fed model of oversight upon which the CSE program was modeled, at the end of the day, we didn't have the backstop. And so when the firms got into trouble, there was no way for the SEC to step in, and the Fed, New York Fed Treasury did instead. And so the CSE program is long gone. It's still, as I said, recited as one of the causes of the crisis. There are other areas where the SEC had been taken to task, and some more appropriate than others, I would say. One in particular is the oversight of credit rating agencies. I don't think anybody would dispute, and I see some smiles. You say credit rating agency, people smile because you probably read a Michael Lewis book recently. The rating agencies undoubtedly fell down on the job. And the SEC, through its imprimatur of certain rating agencies, the big three, Moody's, S&P, and Fitch, calling them nationally recognized statistical rating organizations, NRSROs, and baking the idea of an NRSRO into our rule book. And it's extended beyond our rule book into federal legislation, even outside of the securities laws, helped give the appearance, the imprimatur of government approval of the ratings coming out of the rating agencies. The other thing, when I came down in the summer of 2008 that I inherited, besides the CSE program, was the rating agency oversight program. So that was a wild ride, as we came to realize that in the area of structured finance, right, the collateralized pools of mortgages, RMBS, CMBS, CDOs on RMBS, that basically the rating agencies didn't know what they were doing. And they were stamping things AAA that were certainly not AAA because they were rated AAA. Investors, institutional investors, others were able to buy it. Firms were able to hold it, banks as well as broker-dealers, on their balance sheet and take minimal, if any, capital charges. So the rating system facilitated other issues within the regulatory world, preferable capital treatment, preferable treatment in other contexts of the rule book that really baked in an idea of a product that had been fully vetted and that was ultra safe. And that turned out to be one of the worst things that happened to us in the crisis, because as we saw, all of these products blew up. And in response to that, the SEC has enacted, because of Dodd-Frank and because of other issues, a number of rules to try to address the conflicts of interest and other problems that we found at the rating agencies. You would be surprised to know that we actually had no formal authority over rating agencies until 2006. In 2006, Congress enacted the Credit Rating Agency Reform Act of 2006. It went into effect in 2007 when we put in final rules, but by then, by the time that regime went in place in the summer of 2007, most of the structured finance products that blew up in the faces of various market participants had already been issued and rated. 2005, 2006 was really the bulk of those things. And so it was a boom time for the rating agencies. They made a lot of money off of structured finance deals. Yet still, to be fair to them, structured finance at the time, by number of ratings, represented a minority, vast minority of what they did day to day. Generally speaking, the rating agencies rate corporate debt, straight corporate debt, and generally speaking, they do a pretty good job. But when they wandered off and they got into structured finance, we saw some real problems. And so that was an area where, although the SEC, by the time we got formal authority, did not have formal jurisdiction over these entities, the sort of imprimatur that had built up over the years through our rules, through our no action and staff positions, embedding ratings into our rule book, has been seen as a real problem. So these issues, they come up time and again for the agency. We struggle with them, as we try to move forward and get past the crisis. But as I mentioned earlier, we can't really get past the crisis because in the summer of 2010, Congress passed, as I'm sure you've seen, the Dodd-Frank Financial Reform Act. I forget the full title, Wall Street Accountability, all sorts of nice things. It is an unprecedented piece of legislation, 2,319 pages. You have to hear the metrics to really get your head around what's going on. 2,319 pages. Sarbanes-Oxley was 66. So give you a sense, right, of, and Sarbanes-Oxley was seen as traumatic in the SEC world. Swallowing all these mandates from Sarbanes-Oxley, trying to meet congressional deadlines was a huge trauma to the agency. We have 100 mandated rulemakings out of the 2,319 pages. We have 20 plus mandated studies. And so, this is in addition to the day job, right? This is in addition to the basic, what I call the blocking and tackling of the agency, overseeing broker-dealers, overseeing investment advisors, reviewing disclosures of corporate issuers, enforcement actions, and everything else. This 100-plus rulemaking burden was foisted on the agency, and many of these rulemakings came with mandates, with very tight deadlines. We are currently about a third of the way through Dodd-Frank, which the average American would have no clue. When you hear, especially in a campaign year, you hear, we've regulated Wall Street, we've, through Dodd-Frank. Dodd-Frank is mostly just a series of mandates to regulators. And so none of certain sections of the statute are effective until the rules are put in place. Almost nothing was self-effective. And so, except, of course, if folks remember, they did remove one section from the SEC rule book that allowed the rating agencies to opt out of professional liability in connection with an underwriting. So they forced the agencies to either opt in or opt out. So if a prospectus was going to go out using a rating, and the rating agency let the rating go out in the prospectus, they would be taking on underwriter liability. And so, as most rational market participants would, they decided to opt out. And the day after Dodd-Frank was passed, Ford had to scotch a $30 billion debt offering because they couldn't get a rating to be put in place. So we had to give them relief at a staff level to work around that provision of Dodd-Frank. The rest of Dodd-Frank, the vast majority, requires rulemakings. We've gotten close to 100% of the proposed rules out. As you know, under the APA, we propose rules, we take in comment, and then we go final with the rules. We're almost 100% done. We have a few left on the proposing side. but we're only about a third of the way through the final rules. And so these will be trickling out over the next 2, 3, probably even 4 years. And so the bulk of what we're doing is yet to be seen. The same with the CFTC, the same with the Fed and the OCC, all the other financial services regulators. We're working like mad. We're working at a 10 times normal rate of rulemaking with not a 10 times increase in the size or efficacy of the staff. And we're trying to fulfill these mandates again while at the same time accomplishing the basic blocking and tackling. In addition, as you've seen, I'm sure, in April, Congress passed and the President signed the Jobs Act, which we talked a lot about this morning here. And the Jobs Act comes with a new set of mandates for the agency, a new set of deadlines. These have a very different purpose. Obviously, they're meant to be proactive and create jobs. They're meant to remedy, to be candid, in large part, the lack of action by the SEC to modernize the rule book on the capital formation side. So we're trying to deal with those. We're moving all too slowly, I think. If the net result in a hugely bipartisan piece of legislation is supposed to be jobs, and if we're having a jobs crisis here, I don't know if we're moving quickly enough. But that itself is another set of burdens, as we try to weather Dodd-Frank. When you think about Dodd-Frank too, I mentioned earlier that the SEC and the core statutes that we oversee, the 33 Act, which was created in 1933, which mandates disclosure above all else, and the 34 Act, which created the agency, which gave us jurisdiction over secondary trading and broker-dealers and market participants. The 40 Act, which is the Investment Company Act, it's mutual funds and private funds now in some ways. The Advisors Act, which is the Investment Advisors Act. All of these statutes arose out of another crisis. And you can look back at them, and in their simplest form, they were very bare bones. I think the Exchange Act was 50 pages long. These were very simple statutes. And of course, because at the time, this was a massive expansion of the federal government, right? And with, quote unquote, independent agencies, which at the time they were rolled out, were of questionable constitutionality that had been established later after challenges. And so very simple, very basic, focus on disclosure and enforcement. And that's how the agency got its start. There was, of course, a 5-year lag between 1929 and 1934 before the agency was created. And so you say to yourself, well, what was the response then? How were they addressing the causes of that crisis? And it started off, as I understand it, very much like what we did here after this crisis, where Congress decided to get very active, and they were going to investigate the causes of the crisis themselves. They were going to write legislation, and that process didn't work so well, and they ended up beating themselves on the head and wondering how to best dive into this issue before they proceeded with legislation. They actually ended up bringing a guy down from the Manhattan DA's office, Ferdinand Pecora, who created the Pecora Commission. And this was a tough, hard-nosed prosecutor. He actually dragged down then one of the most powerful figures in America, the chairman of the New York Stock Exchange, put him on public trial. And over the years, he developed through the public record investigation, document review, a record, which is really stellar. I'm sure you guys have it here in the library, the legislative history of the 34 Act, with all of these hearings, all these abusive practices. Some of it will just ring true to this day, with short selling and all these things that were viewed as causes of the crisis in 1929. And some might disagree with some of what Pecora found as a predicate for legislation, but at the end of the day, I think most people are confident it was a real and extended and vigorous process. Here with Dodd-Frank, which is supposed to be the response to the financial crisis, what happened was, Lord knows when we can say the crisis ended, but if you say even calendar year 2008, we had a calendar year and a half later, July 2010, a 2,300-page piece of legislation coming out that purports to respond to the financial crisis. What we didn't have was a Pecora Commission. Congress, I think wisely, in 2009 decided to impanel what they called the Financial Crisis Inquiry Commission, the FCIC, and unwisely, I think, decided to make it a lopsided partisan board, and so it wasn't sort of split down the middle evenly by political party, so there was a majority and a minority. And the FCIC's purpose was to do exactly what Pecoro did, which was to investigate the sources of the financial crisis, issue a report, and then Congress was going to use that to create what eventually became Dodd-Frank. At the same time, Senator Levin, who was the chairman of the Senate Permanent Subcommittee on Investigations, began an investigation of his own of the financial crisis. And that committee is known for doing very thorough, I'll call it Pecoro-like investigations, very diligent, very smart people. The FCIC report was issued. You may have seen it. You can actually buy it on Amazon. I don't know who in their right mind would buy the FCIC report on Amazon. Is the... Oh, really? Oh, interesting. Yeah. Is it in the nonfiction or fiction? Yeah. Literature, yeah. Periodicals. The FCIC report and the Permanent Subcommittee on Investigation reports both came out 6 months after Dodd-Frank was enacted. And so, it makes you sort of wonder about Dodd-Frank, and is it really responsive to the financial crisis? I, as I pointed out, was down in the Division of Trading and Markets. I was on the 30th floor of Lehman Brothers for most of the week of September 15th, and some things in Dodd-Frank are more responsive to the financial crisis than others. And as I said in the speech a couple weeks ago, some things are not responsive at all. And when you have a piece of legislation that made its way through Congress and approved by the president, the way Dodd-Frank was, which was largely, almost entirely, single-party piece of legislation that was going to get done one way or the other. It was very similar to sort of the feather ruffling you saw with the Health Care Act, right? I mean, when you don't have any bipartisan buy-in, you get a lot of upset folks running around D.C., whether they're in the minority or not. And unfortunately, this is what happened with Dodd-Frank. It was sort of rammed through, and there are a lot of hurt feelings on the Hill. There's a lot of hurt feelings by the industry, the regulators. This was sort of pushed through. And so now it's incumbent upon us at the Commission to prioritize. I told you we were done almost 100% of the proposals. We're only a third of the way through the final rules. What do we do next? Two things I'll point out to you, or one thing, one real contrast, is being illustrative of this idea of how we're spending our time, and are we focusing on the right things? We just found out, Steve and I did, as we were sitting in the waiting room at Facebook, that we were sued again today as an agency for a rulemaking we did in August. And this rulemaking involved mandated disclosure of payments made to foreign, or actually the U.S., but generally foreign countries, by U.S. oil, gas, and mining companies for any lease rights. The idea there, and this is a Dodd-Frank mandate, Dodd-Frank Section 1504. The idea there is that to the extent that Exxon and Mobil and other companies need to disclose these payments, that there'll be transparency, there'll be light shed upon these payments. We always hear Angola used as the example, right? So if Exxon's paying $50 million to Angola for a lease, the $50 million will become known at some point to the populace. They'll see that the despot is using the money, for his personal use, and there'll be an uprising. There'll be some sort of correction there. It's a humanitarian sort of geopolitical goal, which is incredibly laudable, but it was foisted upon the SEC by mandate through Dodd-Frank because, as I pointed out, it was a massive piece of legislation ramming its way through. And this bill, 1504 was before that a bill. It was about 3 different iterations of a bill, never got take up in Congress. And so the sponsors of the bill, and this was totally bipartisan, that there was a Republican senator and a Democrat senator pushing this as a standalone bill, couldn't get it through, so they appended it to Dodd-Frank. It translated into a mandate for us to issue rules mandating that all United States issuers, all issuers registered with the SEC have to go, and at least a facial level. We were laughing with the Facebook guys today about whether they use, actually this is, sorry, I switched over to 1502, which is conflict minerals in the Congo. There's 2 bills ran side by side, 1502, 1504. 1504 was extractive resources, and 1502 was conflict minerals in the Congo. We got sued today on 1504 by the American Petroleum Institute, by the Chamber of Commerce. They're challenging whether they should make these payments made. 1502, we haven't been sued yet. We did it the same day in August that we did 1504. There's still, I think, a week and a half left before folks can sue us. 1502 is mandating that every U.S. issuer disclose whether or not they use conflict minerals, which are defined as 4 separate minerals, and I get them wrong all the time, but they're tantalum, tungsten, gold, and tin. Yeah, which are commonly used in electronics and all sorts of other things. Gold is obviously used everywhere, but these are minerals that a large portion of which are derived from the Congo region in Africa. And so I was making the joke, I was laughing with the Facebook guys now that they're an issuer. Welcome to the public life. They at least at a facial level have to make that decision. You would hope for them they can check off no, but you never know. If you can't check off no, if you're somehow a producer, manufacturer, merchandiser, you then have to figure out where you got these minerals. So you have to figure out if they're in your products, if those 4 minerals. You have to figure out if they came from Congo, to figure out whether you know or not, whether your suppliers use it, and you have to have an audit of the process by which you came to these conclusions. So again, great humanitarian goal meant to stop armed violence in the Congo region, which is rampant. However, unfortunately, not a goal that the SEC, I believe, should be used to attain. We have other departments of the government, I think that could be better used, more efficiently used to reach those goals. But my larger point is we spent a lot of time with those 2 rules. And I like to, as I said earlier, throw out metrics so people can get their head around what happens at the SEC, what happens at one of these agencies. I've been a commissioner back at the agency for 11 months. We voted on the rule last month. So for my first 10 months, I think I spent a 5th of my time on those 2 rulemakings, either having meetings with outsiders, reading the filings we were getting in, reading the drafts of the rules. It was incredibly time-consuming, in part because it's new to us, and it should be foreign to us to engage in what we call social rulemaking, things that aren't really germane to investors, but that are sort of germane to certain special interest groups. And so, but nonetheless, these were mandates. They were in Dodd-Frank, and they had 1-year mandates. So we had slipped on those mandates by over a year. The pressure from the congressional sponsors was massive. The pressure from the special interest groups on both sides of the issue was huge. And as I said before, instead of prioritizing other things, we decided, the chairman decided to go ahead with those. And so, as you can tell, I think we should have put other things first. We already talked about rating agencies. One of the other mandates in Dodd-Frank that I think actually is probably the best of all, and I had to practice this for my Senate confirmation hearing in case I got asked the question, what do you like about Dodd-Frank, is Section 939 Cap A, which mandates the removal of references to ratings from our rule book. I talked before about the imprimatur placed on these rules, on these references, on the rating agencies. It's because they're baked into our rule set. So if you use a rating from one of the 3 big guys, then you have lesser capital treatment. If you have a product on your balance sheet that has a AAA rating from one of these guys, you don't have to go through certain hoops. And so Congress basically said, get rid of it. Because one of the problems that was seen in the crisis, and I saw it personally, was a reliance, an over-reliance on ratings by investors and institutional investors as well as anyone else, by regulators, right? We were being lazy too. If it was AAA, it was fine for regulatory purposes, and that turned out not to be the case. The Basel standards, banking standards, gave preferential treatment to highly rated securities. So all of this authority was placed in essentially these 3 rating agencies. And so the idea of removing the references from our rule book makes good sense. Separately, Congress removed all references from federal legislation. That happened overnight with Dodd-Frank. The rule side of it, though, the 939 Cap A side, was a little more complicated, but still very direct because we had to create proxies. So if you're going to remove the reference to the rating, instead of AAA, what do you put in place? You still need some mechanism. And for some rules, that's harder than others, but quite frankly, my old boss, when I worked for Chairman Chris Cox, preceded Chairman Shapiro, proposed the removal of references in 2008 before the big blow up. And so this is an issue the agency's been dealing with for a long time. It's one that we generally know the answer to, even if some solutions are better than others. However, we haven't yet fulfilled that mandate. That was a one-year mandate too. So at the end of the day, of great concern for me, and I think great concern for everybody who's worried that Washington is responding to the crisis. At one level, you look at, does Dodd-Frank respond to the crisis, and are we just sort of having our blinders on and mindlessly following Dodd-Frank instead of thinking deep critical thoughts about what the real causes of the crisis were? And if you accept that some parts of Dodd-Frank, which I do, are responsive to the financial crisis, are we prioritizing those at the head of the list? And unfortunately, we don't do that all the time. And so it's something, as the newest commissioner coming into the SEC, I'm trying to get us to focus on. At the same time, I'm trying to get us to focus on what I, again, call the basic blocking and tackling. How do we oversee broker-dealers? How do we ensure we don't have the next Madoff fraud? Right? Are our examiners savvier than they were before? Because at the end of the day, we can hire 10,000 more examiners. But as you saw in public documents in our Inspector General report, the examiners found Madoff. They were sitting in his office. They were talking to him. They were investigating these tips, and they simply didn't ferret it out. And so you get into sort of core competency issues and tool set, right? Do they have the right tools? Do they have the right technology and resources? And these are very basic issues. We can now regulate, as we're about to do, the derivatives world, the soon to be formerly OTC derivatives world, as we're mandated to do in Title VII of Dodd-Frank. That's a whole cloth area of regulation, and we can spend the next couple years burning up a lot of our bandwidth doing it. But if one more Madoff happens, or if one more MF Global blows up and farmers don't have their money, I know that's mostly a CFTC issue, but they were registered with us too. Those issues are as old as time, right? They're as old as the agency itself and older. That at the end of the day, we're about investor confidence, protecting investors, ensuring that your assets are safe, and therefore ensuring your willingness to participate in our markets. And if we're not focusing on those core issues, if we're not focusing on the core and identifiable issues in Dodd-Frank that are really responsive to the financial crisis, then I worry that we're being set up for the next failure. So that's my perspective coming in as a commissioner, 11 months in, having been on the staff. It was an easier study than most. I was able to get up to speed, but this is sort of where I find us now. And I think it's an interesting case study, agency to agency, but it's also it's a pan-Washington issue of accepting the narratives that have been put forward, sort of blindly trying to do what you have been told to do by Congress, checking the boxes, or conversely asserting your independence and acting like the independent agency we're supposed to be. So with that, and I promise not to be Socratic, even though we are in the law school, so I'm tempted. I would love to get a little more interactive and get into Q&A if you guys have the interest. Oh, yeah, that's why you were smiling. Yeah, sorry.
The mic, I guess I shouldn't make that disclosure again, right?
It's already recorded right here. Yeah.
One thing that I've noticed when working at a rating agency is that there was a problem with how municipal bonds were rated relative to corporate bonds and structured bonds. So a lot of research has shown that municipal bonds are discriminated against relative to those other asset classes. As a result, the municipal bond insurance industry formed by arbitraging the difference between corporate ratings assigned to insurance companies and the lower ratings assigned to municipals. So I think the problem with rating agencies goes beyond structured finance and pretty much incorporates everything. In trying to replace rating agencies in regulation, I'm wondering whether you've considered the idea of open source models that could be used by the industry and collectively improved through a crowdsourcing process so that we have a third-party, independent, transparent way of looking at things. Because otherwise, you're really relying on the internal credit folks at the bank, which is why rating agencies were empowered in the first place.
Yeah, that's a great, it's a really good question. You know, and the issue of municipals being treated differently by the rating agencies is one that was actually pretty well vetted in the Dodd-Frank process, and there at points were mandates. There were several mandates as to credit rating agencies in Title IX of Dodd-Frank, which is all sort of the sort of miscellaneous SEC section, we'll call it. And I think I can't remember if there was a study mandate. The rule of thumb in Dodd-Frank was if you can't figure it out, make them study it. So there's the 20 studies. You know, one of the studies was whether Senator Franken's idea of essentially a utility. You talk about moving in a different direction from removing references to the law and the rules. You know, Senator Franken wanted to have a utility where the government would sort of spin a wheel and hand out assignments to the rating. So further embedding the government into this world. Personally, not sure that's the right way to go. That study's supposed to come out soon, but we'll see. So yes, I still think more work needs to be done on differentiating municipals. We just issued a report on the state of the municipal security, and you'll probably see that we specifically footnoted this issue because of me, that we need to further study whether we should differentiate on the rating side. Now, as to, I mean, structured finance is funny, right? So we talk about fighting the last war. You know, the rating agencies, the whole issue with the rating agencies was isolated in the crisis to structured finance, right? It was the ratings of all these pools of mortgages and everything else that got us into trouble. And the structured finance markets have been dead, completely dead for 4 years. There's almost no activity in them. And so there's been a lot of time spent on new rules for rating agencies as they rate structured finance products. There's been a lot of time spent on ABS disclosure rules, right? The skin in the game rules. You know, should underwriters hold back 5% so they have skin in the game instead of pumping all this junk out? I'm not saying it's misguided. Clearly, these were issues in the crisis, but recognizing, of course, that these markets are now completely dead. You know, maybe we'll see some life in some of them at some point soon. You know, again, you have to take these issues into account as you try to figure out your priorities. As to open source model, I haven't thought about that. Crowdsourcing, you got to come to California to get these ideas. That's why I'm out and about. You know, I learn a lot when I come here. We clearly, you know, recognize that as you take the references out, as you put the onus on the banks, on the market participants to do real diligence. You know, one of the toughest references to ratings that the staff has been trying to come up with a proxy for is in the money market fund context. We could talk about money market funds forever, but on this discrete issue, you know, basically the boards of money market funds get to look at a rating and rely on a rating, and that gives them some level of protection. They like it. Ratings in some ways are like a drug, right? And the rating agencies are the drug dealers, right? Everyone wants to rely on them and say, I've done my work, I have no liability, I can walk away. And so removing the rating from 2A7, which is the rule that governs money market funds, would mandate that the board do more work, and it's just what can they do? And we would imagine that proxies would come in place like models, right? The proprietary models that folks, I'm sure lots of firms around here would invade the space with better technology on how to evaluate risks and things like that. And so, you know, I don't see why you know, mandating it be open source, not positive, and I'd have to think about that. But prohibiting it from being open source, and I don't think we should do that either. So it's an interesting thought.
Parallel to what you've done in your proposed rule on capital waterfall model.
Right. Well, you know what, and I know that those guys were very successful in that rule proposal in getting that baked in. We'll see what the final rule looks like, though. So, yeah, absolutely.
Hey, So in a lot of financial laws, there are capital requirements. And just thinking since the crisis, it seems like there's been a lot of recent high-profile failures, like you mentioned MF Global. The Facebook IPO hasn't been a particularly big success. I don't know if that's why you were there earlier, but
We didn't talk about that. We talked about the weather and baseball.
I'm sure. So do capital requirements work? Because when you have banks like Chase losing billions of dollars overnight, with all due respect, what are you guys doing? I mean, I know you're not a bank regulator, but MF Global within your domain,
Yeah.
It's perplexing to me.
Well, it's a great question because all too often, too much faith is put in capital as sort of the be-all and end-all of regulation. If you charge high enough capital, you can cure everything. I think that was actually, believe it or not, Alan Greenspan's mantra was that instead of wonkish technocratic regulators trying to regulate down to the very minutia of how you conduct your business, if you just simply charge enough capital to withstand a problem here, a problem there, even a minor failure, then you should be okay. This is one of the great lessons of the financial crisis, is the over-reliance on capital measures, right? Basel II was the prevailing, and still essentially is, even though there's a shift now to what they call Basel 2.5 on its way to Basel III, which is literally being created in Basel by international regulators, central bankers in particular. And Basel II, allowed the very thing I was talking about, highly rated pools of mortgage assets to get little or no capital charge, because the idea was mortgages, people paid them, right? If the origination was proper and everything else, which is a big if, people paid them, and so they're not as risky as other things. And so then when you pooled them, they actually became less risky in the minds of some, and so the capital charges actually got lower and lower, where you incented behavior in the marketplace to a point where Lehman Brothers, Bear Stearns had tens of billions of dollars of mortgage assets that turned illiquid on their balance sheet. They couldn't have had them on the balance sheet if the capital rules had been prohibitive, if the capital charges had been adequate to take on the risk. And so, I think pure reliance on capital is a folly, is the lesson of that for me. And, MF Global happened before I got back to the commission, so I'll just tell you what I know from the Wall Street Journal. It wasn't a capital issue. I mean, if you charged, they lost about 1.2 billion, I think, at the high in customer funds. If you charged $1 for every dollar of customer assets you had in capital, no one could do business, right? So I don't think it's a capital issue. That was a really, as I mentioned before, in our paradigm, we're all about failure, right? Capital for a broker-dealer, which MF Global was, is meant to say you have to have enough money around to pay the light bill and pay the staff as they wind you down, right? It's not about safety and soundness and things like that. Because our other rule set is meant to protect your assets, right? The big shame of MF Global, literally, you have farmers in Kansas that don't have money. They're broke because the assets were gone. Now, the CFTC regime is slightly different from the SEC, but generally speaking, the idea is to segregate or remove from the working capital of the firm customer assets. Put them off to the side and check up on them, right? When the examiners come in from the regulator, look and make sure they're there. This was a lesson we learned in Madoff too. And if those rules are being followed and if the assets are there, MF Global is not a story, right? Because the 1.2 billion is there. It goes right back to the customers. And then what are you talking about? You're talking about the principals of that firm lost all their money. Who cares, right? The capital was there to wind it down, and there wasn't a systemic shock. So from a capital perspective, you have some folks, I'm sure, could come up with a theory where if you charge them enough to engage in the activity that left themselves in their death throes, right? If you said you can't engage in these sovereign CDS trades or other things they were engaging in because we're charging you too much capital, yes, I mean, you could use capital to get there. But the notion that capital cures all, I just don't agree with. And but at the end of the day, when regulators create these capital rules, when they allow higher charges for some things and lower charges for the other, it's going to incent market behavior. And one thing we have to do, what are you guys doing? We have to be cognizant of the fact that that creates bubbles, that drives behavior.
I guess what I was asking with that is more, how is what you're doing today different from what you're doing years ago?
On the capital rules?
In statutes where there are capital requirements, are you supplanting that with other ad hoc requirements in other metrics, or is it still capital?
Well, I mean, it depends on your question. I think I was telling you, right, on MF Global wasn't a capital issue in my eyes. You could make an argument if you want. In the context of Basel II and the failure of Lehman, in the Citi, and all the TARP recipients, some more than others, obviously Bank of America and Citi, through acquisitions and otherwise, had a lot of these illiquid assets on their balance sheet. And why were they on the balance sheet? Why was there this bubble in this asset class? Were the capital rules responsive? Yes. And so there's an issue within the capital theory called procyclicality, and you got to guard against procyclicality, right? There's federal housing policy encourages the creation of subprime mortgages, which happened here, right? The banks jump in on it because they've been able to persuade the regulators to give them little to no capital charge on that. So that business line versus another one that gives you a high capital charge, you're going to do that, and you're going to make a lot of money. So at the higher level, the Basel III negotiations, which we're an observer on, but we're not a bank regulator, so we're not a voting member. These issues are being fully vetted out, but it doesn't mean that it's not going to drive the next set of market behavior. I think no matter what comes out of Basel III, there'll be an over-reliance there too. So you say, well, who in the world then is supposed to be watching these things? Title I of Dodd-Frank, as you might have seen, created what's known, we call the FSOC, the Financial Stability Oversight Council. This was another thing you heard during the crisis. We need a systemic regulator. We need one regulator that can oversee everything, that can take in all the information and will have the authority to essentially prick the next bubble, right? It's been impaneled. It's supposed to be looking at these types of issues, our rule sets, our market behaviors, creating potentially the next systemic risk, the next crisis. I too am wary of putting too much credence in that. It's one thing to as we sit here in particular, I'm not an FSOC member. The chairman of the SEC is actually a member of FSOC. The rest of the commission is not, which is a whole different issue. Another wonderful feature of Dodd-Frank, that you create this council of regulators that are making most of their key decisions in their first 2 years of existence, and it's all the heads of all the agencies. So it's a hyper-political group right now, and I think it's unfortunate. They'll be designating entities as systemically important, bringing to bear upon them new capital rules and other things, designating whole industries potentially as systemically important. And so, reliance on FSOC, reliance on the new capital rules. I mean, these are things that are happening. My thought is, and I mention it one more time, basic blocking and tackling, right? When we talk about MF Global, can we examine better, right? Can we just go in and ferret out bad practices, bad actors better, remove them from the equation so that that doesn't drive our regulatory policy? If you drive your regulatory policy to the lowest common denominator all the time, you, generally speaking, introduce needless frictions into the system. And so I think we just need to be better at our core competencies. And I think the agency, quite frankly, at the SEC has gotten a lot better. One of the benefits of the financial crisis is we've had access to a new pool of talent. That's we actually pay pretty well. A lot of folks around the street, a lot of former rating agency folks and investment bankers. We have a guy in our division of trading markets that I used to work in who was the head trader on a CDS desk at Goldman Sachs. These are great talents, even if we're renting the talents, quite frankly, to bring the agency, light years ahead by way of sophistication. It's really working. So I don't know if it's a satisfactory answer, but it's really just getting better at your core competencies and hoping that these sort of, domestic and supranational bodies are trying to ferret out some of the things we saw. But it goes to, I think, to the core point I've been making, which is, have we focused properly on what the real issues were with the financial crisis? And I would commend you, go read the Financial Crisis Inquiry Commission report. You know, the majority report would blame everything on greedy bankers and stupid regulators, and there's clearly, I'm not here saying there wasn't that component of the crisis, but if we ignore other things like federal housing policy and other issues, then we do it at our peril, because it's going to happen again. You know, if the FSOC is sitting there meeting, talking about the next bubble, and not talking about interest rate policy or monetary policy of the Fed, then what are they really doing, right? If they're talking about the last war and money market funds, which they've been talking a lot about, am I confident they're going to actually ferret it out? No, not really. There's somebody else, yeah.
Just a quick comment and then a question, which will be on money market funds.
Okay.
Several of us, many of us perhaps, were in this room about a year ago when one of the heads from the Financial Crisis Inquiry Commission was here presenting it. And I must say that the way it was presented resembles in no way what you've just described. It was
I'm telling
really
you the truth.
well, it was felt much more down the middle of the fairway, to tell you the truth. And a quick comment on capital requirements. In my perspective, the issue with capital requirements under Basel II or MF Global or things like that was usually carve-outs from capital requirements which were allowed for situations where, in fact, the rating agencies had rated things AAAs. So the problem wasn't with the capital requirements, it was actually with the carve-outs. That's just a nuance. But I did want to ask you about the shadow banking system and money market funds, because the SEC is responsible for regulating a large part of the shadow banking system, and a really critical part of what went wrong 4 years ago was the seizing up of the money market funds and the inability of the commercial paper market to roll itself over, which without intervention from the Fed, really would have led to an amazing kind of gridlock in our financial markets. So can you comment on what kind of shapes of solutions for improving money market funds and their regulation kind of are within something you think is feasible?
Sure. So I'll start by saying I actually don't accept the idea of shadow banking. It's a pejorative term used by the banking regulators to vilify, I think.
I'm a banker who worked in the shadow banking system, so
Well, that's fine, but I don't need to accept it. So, I think that you'll see the FSB, the Financial Stability Board, Shadow Banking Committee, right? All these things that are meant to cast doubt on, investment products, essentially, or capital markets regulators. It's hard regulating when you don't have access to the taxpayer dollar. So, money market funds obviously were featured prominently in the financial crisis. The Reserve Fund, which was actually the first money market fund ever approved, broke the buck, as they said. It couldn't manage its portfolio to meet a $1 asset value. It went down by half a penny, which is breaking the buck, because the portfolio manager, the reserve fund, held Lehman paper, which amounted to about $785 million out of a multi-billion-dollar portfolio. And so when Lehman went under, the paper was worthless, and that brought the value of the portfolio down below the buck. And so what was then happening was that many investors wanted to get their money out of not just the reserve fund, but other money market funds. And it's often called a run, similar to a run on the bank. People just wanted to get their deposits back. And so what the Treasury did, not the Fed, was to put in place an insurance program, a temporary insurance program. They used a facility called the Emergency Stability Fund. And
the Fed bought commercial paper.
Right, the Fed set up some facilities, but first what happened was that the Treasury put in place a $50 billion insurance facility that basically said to money market fund investors, it's an FDIC-like claim to say that don't run because these deposits, call them, even though they're money market funds, are insured. And of course, you had $50 billion in insurance, insuring at the time was slightly over $3 trillion in money market fund assets. And so, but luckily, there was no claim ever made on that fund. The government actually made money, and it expired by its terms. And in fact, I think in the TARP legislation, Congress prohibited the Treasury from ever again insuring money market funds. And so, in Dodd-Frank, of course, despite it being 2,319 pages and despite it being responsive to the financial crisis, there's not one word of money market funds. And so this current spate of activity with respect to money market funds has been generally led by the SEC chairman, who's a member of the FSOC, and her proposals, you asked about some of the packages, generally were created in conjunction with the Fed, in conjunction with the Treasury. They follow on what was a full-on rulemaking in 2009, 2010 by the SEC to make the money market fund products more resilient. The 2010 amendments required more liquidity on a daily, weekly level. They required stress testing. They essentially made the products more resilient to times of stress than they were in 2008. They did not in any way, no one would say though, put the products in a place where they could weather another 2008 storm. And so they performed much better in 2011 when we had the European crisis. There were major outflows that they were able to handle, but there was this lingering concern that the structure of money market funds, sort of maintaining by rule a $1 net asset value, the buck, and the fear of breaking the buck drives behavior that creates runs. And so what we saw with these proposals that have come out largely of FSOC were the leading proposal was to create a capital buffer, literally called a capital buffer, which would be very, very small. We talked about bank capital, we talked about broker-dealer capital. We're talking about, when we talk about those two things, we're talking about capital in the amount of, arriving at 8% or more of assets of these firms, huge amounts of capital. Money market funds, by their structure, are meant to be managed to $1. There's not a lot of capital there. And so the capital buffer idea was meant to just say, well, it'll be the first line of defense if there's some trauma, but it was widely recognized by everybody, again, that like the 2010 amendments, it would do really nothing in a 2008 crisis. It might stem the flow a little bit at the front end, but if people are going to run, they're going to run. So there was introduced, in addition to the capital buffer, the idea of a holdback. So if you left, if you had 100 grand in your money market fund account and looks like the storm clouds were coming and you ran, then they would hold back 3% of your monies. And so you would have $3,000 stuck at the money market fund. You could get it back 30 days later. That might be okay with you, depending if you're, if you want a little extra yield, you're in a money market fund instead of a bank product. You might not need that $3,000. But for institutional investors who use money market funds as cash management vehicles, that would not be okay. They're, large, sometimes fiduciaries, they can't have the money locked up. They need a dollar out and they put a dollar in. And so, the feedback from these proposals was that it'd be catastrophic for the industry. The alternative was what we called the floating NAV proposal, which essentially would say, instead of managing this product per our rules to $1, let's just treat it like any other mutual fund, that you will manage it as best you can, in most cases to $1, but at the end of the day, it'll be marked to market just like a normal mutual fund. And so some days it might be 98 cents, some days it might be $1.01, you never know. But it'll fluctuate slowly and on a somewhat regular basis. The idea there is that investors will be reminded constantly that this is an investment product. This is not a bank product, right? That you see the value ebb and flow. That especially if you're an institutional investor, where now if you get out early, you get $1 back, right? Even if the asset values have fallen below $1. So that's what they call the free put in money market funds. It drives behavior so that you want to get out so you get the full dollar value. That would be gone, of course, so there's some virtue there to that. And there's another issue with money market funds that we've been trying to deal with, which happens every now and again, called parental support, where you might have a Schwab fund, and Schwab's a big public company. They have a money market fund. If one of the holdings of the money market fund defaults, they could come in, buy it out from the money market fund and to preserve that $1. That's happened several times over the last 30 years, where if it hadn't happened, the buck might have been broken. It's not assured, though. You don't know if the parent's going to come in or do it. They might do it on Wednesday, but not Thursday. They generally need to come into the SEC staff to get relief to be able to do this. So there are so many uncertainties associated with that parent support that it's another issue on the table for us to address. And I think that the floating NAV proposal would go a long way to addressing some of those issues, right? If the parent wasn't so concerned about preserving the buck, there'd be less impetus to come in with that sort of irregular support. So those proposals did not garner, as they were constituted, a majority support at the commission. And so our chairman has asked the FSOC to intervene, which is the first time since creation of the FSOC, the first time since Dodd-Frank was enacted that the FSOC has gotten involved. The Secretary of the Treasury issued a letter a week or so ago mandating that the FSOC look at this issue and essentially pressuring the commission. My strong hope and guess is that we are going to get back to the table with a package that we as a commission can support that I would assume and hope that would stave off further FSOC action. What shape it takes, though, I'm not exactly sure now. I'd like to explore better, the floating NAV proposal. The capital buffer, as you can probably tell, I just don't believe does the job. One other thing that my colleague Troy Paredes and I have put forward as a potential solution is gating, essentially holding up the redemptions from the funds. This happened in 2008 a lot in the hedge fund side. Now, admittedly, much different investors in the hedge fund world, but where the hedge funds got a slew of redemption requests in, a number of them gated, just said, no, we're not going to give you your money back because otherwise we're selling into a fire sale. We're going to lose money for everybody. And it was a big decision to make reputationally because if you're trying to attract investment, obviously you don't want people to think you're trapped. However, it did save a number of those firms. And so one of the things we thought warranted a proposal and attention was the idea that the board of directors that oversees money market funds we could give them the authority to, in the case of an extreme crisis, break the glass and stop redemptions if that meant that you were going to stop a run. And therefore you would stave off the need for the Treasury and Fed to intervene. So we will see how this plays out. It's one of the biggest issues, quite frankly, at the commission. Right now it's caused a lot of commotion and media attention and everything else. And my hope is, again, that we can just get back to the table as the commission's supposed to do and kind of proceed with our internal processes to get something done there. That answer your question? I think. Yep. Great. Thanks, guys.